Yes, boys. So today we're going to be going over equilibrium. Now, in the forex market, equilibrium it represents like the balance between currency supply and demand. So, at any given time, there are millions of traders, whether that's your central banks, your institutional traders, or your individual investors, which are your retail traders. Now, they're all exchanging currencies, each with their own goals and targets that want to be met. But despite all that chaos, the market will constantly seek a state of balance where the price of one currency relative to another reflects all available information. Now, this balance, called the market equilibrium price, is where buyers and sellers agree to trade. Now, when demand for a currency equals its supply, the market reaches equilibrium. So, for instance, if traders expect the US Federal Reserve to raise interest rates, the demand for the USD will increase, which pushes price higher until the equilibrium is found once again. Now, this constant push and pull between buyers and sellers is actually what creates price movements. Now, that also forms the charts that we analyse every single day. Now, if we have a look here, you've got, if I can find an example, so let's say you've got this consolidation area here. So I'll just mark out. So you've got this consolidation period here. Now, these consolidation zones they're great examples of equilibrium in action, and that's because after a sharp price move, which is driven by speculation, news, or whatever it may be, the buyers and sellers will reassess and they wait for more information. Now, during this period, the market stabilizes, forming what you could call a balance point before the next major move happens. Now, for traders, identifying these equilibrium zones is very crucial for predicting breakouts and reversals. Now, equilibrium in forex is like it's like any other market. It's dictated by the supply and demand. Now, imagine sort of a major export-driven country like Japan urging large amounts of foreign currency. Now, this increases supply for foreign currencies, which affects the exchange rate. Now, simultaneously, global demand for the Japanese yen may rise if investors were to seek it as a safe haven, which is known for a safe haven is things like gold. Now, the exchange rate it will always adjust until supply and demand are in the balanced area and a new equilibrium is reached. But the thing is, equilibrium is never permanent. It's constantly disrupted by external factors, major economic reports, or central bank policies that can shift expectations. So now that you know what equilibrium actually is, how can you actually use it and find it in your charts? Now, so what I've already said is when you're in a consolidation area and then you see a big breakout or something happen, or a nice impulsive move, then you can then know that price is then going to be searching out for that equilibrium to find its balance in the market. So what I use, you can use your fib tool or a GAN box and then just change the settings to make it out to just so you have 0, 1 and 0.5. Now, the 0.5 on a GAN box or a fib retracement is equilibrium. It's the middle of that whole move. So to draw it, you would first of all find a small consolidated area. So we could say here. So you've got this small consolidated area, and then you've got a large impulsive move, which was most likely news or any other period of time. Now, what you would do, you would get your tool and you would draw it from the low before the breakout up into the recent high before the price starts rejecting and starts moving back down. Now, once you've marked that out, you know where your equilibrium is and you know where price is likely to be filled. likely to target and wants to seek out balance, of course. So yeah, that is all I'm going to be going over today on equilibrium. Now, if this has helped you understand what equilibrium is, make sure to like and subscribe, and I will see you in the next one.